right, welcome everybody to today's panel conversation, How to Prepare for a Capital Fundraise, hosted by the CEO's Right Hand. My name is Andy Saldana. I'm the Executive Director of New York Tech Alliance. New York Tech Alliance is a nonprofit organization that works to connect and create an accessible and equitable tech ecosystem here in New York City. To learn more about us, check us out at nytech.org. Please join us for our upcoming events as well. Before we get started today, just a quick thank you to all of our annual partners who make the work that we do very possible. They support us in all aspects of our business, everything from Work Better, who provides co-working spaces and private offices, to Grasshopper, Google, NYIT, and of course the CEO's Right Hand. A special thank you to the CEO's Right Hand for helping us put together this panel today. I'll be turning it over to Eric Meisner and William Lieberman in just a few minutes. But here's their contact information. Please be sure to check them out. They're here to help you with all of your financial needs. Our next couple of events coming up, we have a pretty slow month here in July, but we're excited about what we do have on the schedule. Next up is next Tuesday, July 14th, will be our next session of New York Tech Latinas, the Latina luminaries. We'll be highlighting a high-level Latina in the New York tech ecosystem in an Instagram Live interview. It's done by our board member, Yvonne de la Pena. It's always a great session. You can find that information on our Instagram at NY Tech Meetup. And then Tuesday, August the 4th is our next New York Tech Meetup. Will be a very special high school edition where we will be highlighting high school projects from various high school organizations in the city. So be sure to check us out. You can always find our events at nytech.org/r_events. And then with that, I'm going to turn it over to Eric Meisner. Eric, go ahead and take it over from the CEO's Right Hand, and hope you enjoy the panel today. Thank you.
Great, thanks, Andy. And good afternoon, everyone. I hope everyone listening is safe and healthy and in good spirits in light of everything going on in the world today. I'll start with a quick elevator pitch. I was a big company guy early in my career. I worked at Deloitte, Viacom, and AT&T. A few A&T executives were recruited into the internet startup world during the big .com boom of the late 90s, and they dragged me along for the ride. And we were about the biggest crash back then. We burned through about $500 million in a year and went under. So all my friends and family told me to go back to big company life, but it was too late. I was completely hooked on startups. And I've been helping startup companies grow and scale as both a controller, then CFO, for over 20 years now. I enjoyed it so much that in 2016, I turned to the fractional world so I could help multiple startup companies at the same time. And the last 2 years, I've been a partner at the CEO's Right Hand, and working with my partner in crime, William Lieberman, and I'd like him to introduce himself as well. Here's William.
Thank you, Eric, and welcome again, everybody. And glad to be here and glad to talk about fundraising and what it takes to prepare for a fundraise. My quick background is an entrepreneur. I've built and started many different companies over the years. Started investment banking here in New York, and then started an investment management consulting practice out in San Francisco. And from there, I spun out a fintech company that I built and ran for many years. And although I'm dating myself, we were one of the very first, not the first, subscription model software businesses for the financial services industry. And then about 5 years ago, I sold my stake and I formed the CEO's Right Hand. And we act as strategic financial partners to early stage growth companies to help them grow and scale. And so we represent finance and accounting for a variety of types of companies, a lot in the tech space, and provide that financial acumen and leadership to the early stage companies, including not just finance and accounting, but FP&A, financial modeling, tax, and on all the things that have a dollar sign in front of them. And that's where we get involved. And so we're looking to help you folks as we can, and hopefully get some good information from today's session.
Thanks, William. And our second panelist is the partner in charge of technology and life science at Eisner-Amper, right here in the New York tri-state area. Folks, please meet John Pennant. John, you might be on mute.
I am. Thank you. Pleasure to be here today. Thanks to the council, the Tech Alliance for inviting us, and to you, Eric and William, for having me as part of your panelists. I head up the technology and life sciences practice for Eisner-Amper. So that's a role that used to take me around the country. So spending time in the tech hubs around the U.S. and with our teams and clients all around the country. So now I work from my home in New Jersey here. Makes it a little easier on the traveling. But our firm is one of the largest firms in the U.S. We're in the top 20 in terms of overall size. We focus on a bunch of different industries, but my focus is tech and life sciences. Our group is national in focus. We're doing audit and tax work and some outsourced accounting work, valuations, helping with lots of M&A transactions, IPOs. Internationalization's been very popular, and of course things like taxes, very complicated sales tax for some of those SaaS models and tech models and things like that. So it's been quite interesting over the last couple of years. I've been doing tech and life sciences personally for about 25 years, about the last 16 years here at Eisner-Amper, and we've seen really nice growth in the practice, and happy to share my insights with everyone.
Great, thanks, John. Andy, I think we're ready for our poll question.
Yep, you got it posted.
We lost Andy.
I think it's open, so if we're just going to give it a few minutes. The whole question is, what company are you? And I'm seeing some answers come through, and while everybody gets answered, I think Eric, over to you.
Yeah, so while we wait, I thought the panel, if you guys want to give your thoughts on the state of the market for fundraising today, Jim, why don't we start with you?
Sure. So I did a little research. So far in the first quarter of 2020, according to Crunchbase, $63 billion has been invested worldwide in venture capital deals. Now that's down 8% year over year. But it's probably also importantly to note is it's down 17% from where things were at in the first quarter. So obviously the total dollar invested is less than you expect. VCs are still raising money. They raised $21 billion into their coffers in the first quarter of 2020. So they're going to have to do something with that money. And one of the things that we've seen is that there are a smaller number of larger deals. So what used to be like a late stage venture capital deal, or perhaps even a private equity deal, is now a Series A. So you're seeing 50, 80, $100 million Series A rounds. So smaller number of larger deals. There's still somewhat of a void in the smaller size deals, where like a traditional or an old-fashioned perhaps Series A of like $3 or $5 million, those are still a little bit harder to come by. And I think also just one last comment I'll make is, so far this year, there's been 10 venture-backed IPOs that have been done in the tech space, which is down a fair amount from where it was last year. But on the other side of it, in life sciences and biotech in particular, the IPO market couldn't be hotter right now. So everybody and anybody is trying to get their biotech company out into the marketplace as quickly as possible. So I'll stop there and turn it over to William.
Yeah, so what I'm seeing sort of anecdotally are that deals are getting done and people are out raising money, especially equity VC money is happening. It's maybe taking a little longer and companies' funds are being a little bit more picky, but for sure deals are happening. We have clients that are in the process of either in market raising money or about to go to market to raise money, and we're helping them put that information together. And there's a lot of money on the sidelines. So the funds themselves have been waiting to see how the pandemic plays out and where they're going to place their bets for sure. But their LPs didn't withdraw their money. And I don't know, John, if you've seen that on your end, but the funds that I'm talking to and seeing, their LPs are in wait and see mode. So they're not withdrawing. They're ready to make good investments.
Yeah, I think it's been interesting because some venture capitalists have talked a little bit about saving a little extra money to prop up their existing companies, maybe a little bit more than they had originally thought, but they're still mandated to put money to work. There's not enough. They have too much capital to just continue to support their existing investors, so they have to put money to work. So they are out there, busily scouting, looking for deals. But again, I'd say probably more larger deals than a lot of smaller ones, but there are definitely deals out there to be had.
Great.
Great.
Right, Eric.
Great. Andy, how are the results of the poll coming along? Yeah. All right, we'll get those results later. Andy, chime in when you want. Okay, so we have a nice agenda for you. We're on slide 5, Andy. Today's agenda, we're going to review financial infrastructure.
Sorry about that, Eric. My computer didn't want to come off of mute, but just quickly to go over the results. 8% people say they're 2 people in a garage. The majority, 28%, say that they're early stage. And then another 8% are funded. And then 0, I'm a unicorn. So those are pretty much the status of the poll results. Again, I apologize for that delay.
No worries, no worries. Okay, it's good. We understand our audience a little better, so that's very helpful. Okay, today's agenda, we're going to cover financial infrastructure, clean data, pro forma financials, cap table management, corporate documentation, and the fundraising process. Okay, so even though I'm technically the monitor for today's event, I'm going to take the lead on walking through the financial infrastructure section of the presentation. So just like in the business world, it wouldn't be a successful cap raise conversation if your company didn't first have a solid financial infrastructure. Potential investors are going to ask very hard questions and require lots of documentation during their due diligence process. And like, in all honesty, if you can't provide good answers or existing documentations immediately, you're going to leave a negative impression about your company and the management team. So, and as well, it could also lower your valuation. So let's discuss some of the key components for a company's financial infrastructure. And while we do this, think about your company and whether or not you have these processes in place or not. Okay, so we're going to start with cash management. And look, cash needs to be tracked on a daily basis when you're in startup mode. As well, you should have weekly and monthly forecasts and check them for accuracy versus your actual cash inflows and outflows. I know most of you are in startup mode. You're probably pre-revenue. On that note, it's very important to know your monthly cash burn. You need to know how much cash is going out the door, and you match that up. You align that with your projected revenue, future revenues, and that's how you determine how much capital you're going to need during that round. So again, cash is key in startups. I imagine most of you already knew that. Financial cushions, you always want to have a cushion or reserve for the unknown, right? Like a coronavirus, right? Always have a little something extra in the bank just in case. And if you're trying to gauge how much you should have on the side, a good rule of thumb is always have enough to cover 3 to 4 weeks of payroll costs. You don't ever want to miss a payroll. Tap out your credit cards if you need to, but if you ever miss a payroll, you're going to spend most of your time on the phone with the Department of Labor trying to explain yourself. So always leave yourself a nice cushion. And bank recs. This is part of your monthly book close process, which I'll walk through in a second. But you need to reconcile the cash in your ledger against your bank balance and investigate any variances. This is also a great way to detect any possible fraud. Okay, next up, the monthly financial reporting process. Look, it's very easy, and we see this all the time. Entrepreneurs, it's very easy to just lock in and focus on the operations. But investors, especially investors who don't know you, they want to know the management team takes their financials and their financial reporting very seriously. The items we've listed on this slide, this is the bare bones minimum of analysis you should be doing on a monthly basis. And most important, and I'm going to say this a bunch of times today, how are your actual results doing compared to your budget or your forecast? Or also known as your expectations. That, here's what you did, here's how you're expecting to do. And look, you're going to have hits and misses, but the important thing is how quickly can you pivot if you're not meeting them. So certainly something to think about. You got to be ready to pivot on the fly. One more thing about financial reporting. Again, you get caught up in the operations, and you might feel like you don't have time to do the financial reporting. A common mistake in startup mode is to just force someone, the office manager, someone marketing, to become a bookkeeper. And that's okay when you're in startup mode, but at some point, sooner or later, you're going to need your books and records to be in accordance with GAAP, right? So you can pass that audit or pass that due diligence process. Excuse me. And in the due diligence process, very often investors will send in some experts who do a quality of earnings or a QE report. And what they're doing is they're going in and assessing the strength of your books and the accuracy of your books, to find out what's really going on in there, right? They have to look for your add backs. Right, or you have personal expenses going on in there, they're going to identify them. Do you have things recorded in the wrong accounts? They're going to find this, and the more things they find, the lower they're going to rate your quality of earnings, and that could certainly damage your valuation. All right, so there's tons of financial controls that a company can put in place. Here are the top 5, and really the top 3 you see on this chart. Timely preparation of financial information, the accuracy and completeness of your records, and prevention and detection of frauds and errors. Again, all covered during the financial reporting and cash management process. Safeguarding of assets. This is really cash management again. Cash is your biggest asset. And your inventory, right? You have at least an Excel spreadsheet tracking what all your inventory is. And policies and procedures. Now, look, ideally, if you're a mature company, which we know most of you are not, you're going to have all these processes documented. Now, that's not really expected in a startup, but it's good to have at least your key processes documented. And the 2 reasons I always tell clients. You can use it as a training manual, right? You're hiring new people all the time. You hire a new accountant or someone in accounts payable. Well, if that process is already documented, you can just follow along. You're not starting from scratch. And second of all, this is where a lot of CEOs get in trouble. Procedures it's a way of empowerment, right? Because like in a startup, very often the CEO makes all the decisions, right? And then you start growing, or now he's got to go meet with an investor, or now he goes on a sales pitch, and he's in California for the week. Well, very often 0 decisions get made until he's back on Monday. But having policies and procedures in place are a good way for everyone to follow along and know what they're empowered to do when the CEO is not around.
So Eric, let me ask you a question here. This is John here. So for early stage companies, who should be signing the checks and sending the wires out for these companies?
So that's a great question, and I actually just had this conversation the other day. So I have an answer, but first of all, before we even send out that wire or ACH, make sure that first of all the invoice comes in, right? Here we go. We're going to create your policy right now. You got to record it as a payable in the ledger, right? And then you have to have it approved. You have to go find the person who ordered, whatever this item is, get it approved by them, and make sure they acknowledge whether or not it's in the budget. All right, so let's do all that first. Okay, now you actually have to pay it. how often are you paying it, right? So, and I know I'm expanding on your question here because we run into this all the time. The CEO runs into the bookkeeper and says, "Hey, I need a check." Look, if you're doing that every day, you're taking up a lot of the bookkeeper's time, because whether you're doing one wire a check or 50, it's the same 20 minutes for them. So get in a cadence. Hey, look, we only cut checks on Thursday, right? Or I approve them Wednesday, we we cut them Thursday, and the payments go out the door on Friday. Get yourself in a cadence. Yeah, like, it's very easy to say everything's important. We have to pay this right now, but definitely get in a cadence. But to answer your question, finally, you have to have dual authorizations, right? So if in any of your companies, if one person is writing the check and signing the check, it's an issue. If they're going into the bank platform and setting up the ACH or wire and then sending it, you don't have dual authorization. So absolutely it doesn't really matter who they are. Of course, one should generally be an executive, maybe the CFO or the CEO, depending on your team. But always have dual authorization. And in fact, most banking platforms, they actually insist on it, because they're just as worried about fraud as you are, because they don't want to waste time, tracking things down. So yeah, definitely have the dual authorization on all payments going out. Okay, the next item up under infrastructure is KPIs. So KPIs, key performance indicators, are all about measurement. If you can't measure it, you can't manage it, is a well-known saying. And it becomes part of the financial reporting process. You need to compare your KPIs, your actuals, against, again, your budgeted expectations. And then management should make decisions, again, pivot. Hey, our KPI, we're hitting or missing our KPIs. How do we pivot in our operations to get back to where we expect it to be? Again, generally, these are expressed as a KPI or a formula: revenue per customer, cost per unit. Part of the monthly, creating dashboards and discussing this, with your management team. Again, all part of the monthly reporting process. And yes, again, this is all part of the planning exercise. So at the end of each month, you can compare your actual versus your expected KPI results. Some of you, and I'm saying this because I've seen this when we set up new clients. How do you actually figure out what my KPIs are? The easiest answer is just follow your industry, right? I'm sure all of you have public companies in your space. Find out what they measure to. Ton of SaaS companies out there. Just off the top of my head, monthly recurring revenue is probably the biggest one. Number of users, customer acquisition costs, customer churn. Again, know your industry, know your top 4 or 5, measure them, manage to them. If you're not sure what you should measure to, ask your advisor. Then quickly to wrap this up, chart of accounts. The big thing here is your books and records. Your investors are going to want to see things on a GAAP or accrual basis, not on a cash basis. When they're ready to start the process, you don't want to hold things up for 2 months, because you have to do that cash basis to accrual basis conversion. So keep that in the back of your mind. The other big thing we like to tell clients is use account numbers, not descriptions, so you can have a nice order and it flows right into your reporting. And try to maximize the functionality of your software. You don't want to do things manual. So anywhere you can automate within your system, and it helps a lot in the reporting and the monthly recurring journal entries. So always take advantage of the capabilities of your platform. So that's my section. I'm going to pass the torch over to John, who's going to talk about clean data.
Okay, thanks, Eric. Next slide, please. You can go to the next one also. So one of the things to think about as you're gathering your information is you're using, every company is using some systems currently to track their business. So whether you have a front end revenue engine, whether you're using a time card, time tracking system, web-based system, payroll. There's a number of different systems that every company is using. And that's sort of the starting point for one of your data. So one of the key things is that source data ultimately will drive into your books. So you want to look at your source data first, which you're probably doing on a regular basis anyhow. That's how you're managing your business. And those are the key things that are driving your KPIs and the like, as Eric just referenced. So that data, you want to make sure that data is clean. And then you want to be able to bring that data into your accounting records. That does drive, the amount of revenues, the amount of payroll, the amount of job costing on particular projects, whether it's an R&D project or a customer billable project, et cetera. So bringing that data in that's clean, reconciled and accurate is going to be a real lifesaver in terms of time and activities. You can also do the same thing using technology to bring in your bank data, bring in your credit card data, and make sure those items reconcile as well. And then, sort of taking care of the books in sort of a general way to think about it from sort of a GAAP perspective and preparation of tax returns, as you reconciling those key accounts that are driving the business. And then you're looking at some of the other things like fixed assets and loans and equity and things like that. We're going to talk about the cap table in a little while here. Super important to have those things well controlled, organized, and properly reported on a timely basis. So one of the key things here is you want to be consistent in the way you report things, and you want to have a professionalized way of looking at this. So I'm going to give you an example. We can turn to the next slide here. So I'm working with a company right now where they're applying for a very significant federal grant, and they have to supply books. The company's been around since 2013, has no books. None, absolutely none. Never filed a tax return, never put anyone on payroll, zero, absolutely zero. They had a deadline of last night to submit something that looked like books. So, we kind of started down a path of saying, can we actually create books from starting at zero? And the answer is yes, but we would need an enormous amount of time. They've been around for a long time. The entrepreneur couldn't remember what certain things were and were not. So he put together something and submitted it. I'm not sure what he submitted, but I'm sure it's not right. But by not having things done timely, by not having books accurately prepared, we're now going to have to do this laundry machine worth of cleaning up of his books to prepare something that's going to be useful. Whereas if he had done it all along, it would have been a small, manageable project that he could have dealt with each year. Now it's an enormous project to get it caught up. So timeliness is everything. It's a pain, I understand, but it'll save you a lot of time in the long run. And probably most importantly is when you do have real business applications, like in this particular entrepreneur's case, he had the opportunity to apply for a very significant grant. It's game-changing for their company. He was unprepared. So this was a significant source of panic. Next slide, please. Okay. So the other part of this is, if you do wait, you do have this massive cleanup, and you, by going through this on a relatively timely basis, at least annually, to at least get your tax returns done, but it really should be more often than that. You can come up with ideas to maybe manage the business a little better. You'll have some real-time tracking information. We're going to talk a little bit about projections down the road. You can see how you're doing against your projections. Now, all entrepreneurs kind of know that in their gut, but having the data and the numbers behind it really helps you to crystallize those decision-making processes and on a real-time basis. And get some help. Use technology is good. There's, like as Eric had referenced, there's lots of great banking tools out there to make things easy for you. Payroll systems are easy to use. You can administer everything from your phone. Very cool. Just pull it all together. And I guess I better stop here since my phone's ringing here. Probably a robo sales call here. So. I'll put it on mute for 30 seconds. We can go to the next slide now.
Hey, John. Quick question for you. You're an auditor. You're a startup company. Do these companies need to have an audit performed before a fundraise? And please answer that, keeping in mind these guys are managing their cash. Cash might be a little tight, which is why they're doing the raise. What's your view on getting an audit performed?
So I don't think my CEO is on this call, so I think I can respond truthfully. So
Thank you.
he would say that we should all have an audit done, but the truth of the matter is that you shouldn't do an audit until you're required to do an audit. So oftentimes after a Series A investment, there'll be in the deal docs the requirement for an audit from that point forward. Prior to that point, I would not recommend doing an audit. I would recommend considering doing a review or a compilation by a recognized accounting firm like ourselves. So the advantage of doing a review or a compilation with a complete set of footnotes and the like is that the output looks identical to an audit. It has all the elements that an audited financial statement would have in it. So discussion about your accounting policies, your revenue concentrations, your stock options, your tax positions, et cetera, full financials in terms of cash flows and stockholders' equity. But by using a review or a compilation, you can avoid the documentation requirements and testing and verification requirements of an audit. So you get a very professional looking product, something that you can be confident and proud to hand to an investor, a potential banker, venture banker, et cetera, but saves you a lot of time and effort over the audit.
Great, thanks. Hey, William, why don't you walk us through the pro forma financials section?
Sure, absolutely. So when you go out for funds, the first thing, one of the very first things the investors are going to look at are what are their prospective financials for the business. What is this business going to generate in terms of revenue and profitability over the next 2, 3, 4, or 5 years? What's the return on my money if I'm an investor? What's the return on my money for my limited partners, or if it's an angel, my own money? And what's the risk of that happening or not happening? So you want to have really good comprehensive model so that you can answer the questions that are going to be coming from these sophisticated investors. And I'm going to assume that we're talking about sophisticated investors. Again, it's going to be either angel groups, maybe a high net worth individual who's still going to be sophisticated, or venture capital funds. Those types of folks are really going to be interested in understanding the details behind your business model and how that translates into the prospective revenues and profitability of the business, and what are the drivers along the way. What's going to generate revenues from a marketing and sales perspective, channel perspective, and then what are the costs to deliver those revenues, product development, R&D, how much tech, et cetera, et cetera. So having a good financial model is extremely required. It's a major requirement, obviously, of a fundraise, but it's also extremely helpful for operating your business on a go-forward basis. So one of the main outputs of creating a model is helping decide how much you need to raise. And Eric mentioned earlier about, what's your cash burn? Well, so how much runway do we have? And you need to have a good model that tells you how much runway you have before you need to go out and have the next round of funding come in. And then, as I mentioned, taking your financial model that you use for investors, you can convert that into an operational model so that once that money comes in, you now can manage the business going forward and look at those variances, again, that Eric mentioned, the ongoing monthly reporting. Look at your variance analysis easily. Next slide. So when you're building a financial model, there's a lot of different parts to it, right? And many of you have seen these. There's templates out there. There's simple ones. There's complex ones. These types of information that we have on the screen shows you the different types of components that we typically see in a model that's used for, a Series A round, a small or seed round. Sometimes a Series A round can get a little bit more complex, again, depending upon the business model. But the types of things that you're looking for, key assumptions, what are you assuming? And this is one of the most critical pieces to it. What are you assuming for the big pieces or the big variables in the business? So for example, how much are you selling your software for? If you're a software business or SaaS business, what's your monthly subscription price? And do you have different levels? And what's your lifetime value customer? How long is a customer, are you expecting a customer to be a customer? So those types of things are critical and provide the sensitivity analysis so that as you're building the model out, you say, well, what if it were, this much higher? What if our acquisition rate was, 100% instead of 50% month over month in the beginning months? So you can do that sensitivity analysis by having those assumptions clearly spelled out. And then that will drive your revenues, right? Typically the assumptions lots of times are driving your revenue model. And we'll look at an example of how what that looks like. And then the other pieces, right? So operating expenses, how much do we have to pay to, for the back office, for insurance and rent, if we still or even have rent these days, but personnel, and that leads into the hiring and the planning. How many people are we going to need month by month for the next 12, 18, 24 months, and then annually beyond that in each area, right? It's not just product development and R&D, it's customer service, sales and marketing, and on sort of management and administration, right? So you need to have that, and how much are those people going to cost, and variable compensation in addition to base salary and benefits. All the moving parts of compensation and cash compensation need to be thought through. And from there, you generate the financial statements, income statement, balance sheet, statement of cash flow. And at some companies, you'll look at working capital, like accounts receivable is a factor in some companies. And what does that look like on an ongoing basis? And then from there, you take all those pieces and you can create a presentation, again, just another tab in Excel or Google Sheets to show it investors and part of your pitch. Next slide. So once you have that model, the big piece of it is thinking about the revenues, right? So what's our forecast look like from a revenue perspective, and how do you put together a forecast? Well, there's a couple of ways, right? So top down is looking at the total market and how much of that market we're going to get. Bottom up is, hey, if we spend this amount of money on advertising, what does that translate to in terms of customers? And we'll again look at one of those examples in a second. But on the top down basis, let's say, there's an easy example. Let's say you sell cars, right? So how many cars are there in the world is the total addressable market. How many cars are there, right? Or what's the total dollar value of all the cars that are being purchased around the world? That's the total addressable market. Then the serviceable available market is your niche. So say I sell electric cars, right? I sell electric cars in North America. So that's our serviceable available market. And then the serviceable obtainable market is, what do we realistically think that we can capture? So of the electric vehicles in the United States, we think that we can get 0.5% or 1% or X%. And we think we'll get this amount this month and this amount this month and this amount, and you build it out from there. So you start with the total addressable market and you work your way down to, okay, well, what do we realistically think that we can achieve given the assets and the resources, and given the fact that we're going to have X dollars coming in from a new capital, new equity, given that money, how do we go after it and how much are we going to get? Next. So that's top-down forecasting. So from there, or that's sort of one approach, the bottom-up forecasting, and sometimes you're going to merge these two. But the bottom-up forecasting is much more based on data that's already, hopefully, you have about your product and service that you're delivering, so you can extrapolate out. So say, hey, if I spend this amount of money on, let's say in this example, in a SaaS subscription model, if I spend this amount of money on Facebook ads, or it could be LinkedIn or Google, and CPM, cost per impression, 1,000 impressions is this, and I'm going to get this amount of impressions. Here's my click-through rate, et cetera, conversions, et cetera. What does that translate to in terms of revenue dollars out the other side? So very detailed, data-driven, bottom-up approach. And you could say, well, what happens if I spend $15,000 a month? And there's that sensitivity analysis that you're going to use and adjust your assumptions. And these are the types of things, these are the types of data elements in your financial model that an investor is going to be drilling into. How do you know your CPM is $50? How do you know your click-through rate's 1%? How do you know your conversion rate's 5%? And you need to have crisp answers to those types of questions. Building a financial model and making sure you have a robust model to show them shows that you've thought this stuff through. And that's the number one thing investors are looking for is making sure that you have thought about and have good answers for why you think you're going to achieve. Every financial model is a hockey stick, right? So why do you think that your model is going to, or your business is going to be able to achieve those results over the coming years? And this is the type of analysis that you need to be doing. Next. So once the forecasting is done, then you can build out the model. And this is just a quick snapshot of what something might look like. This is a bottoms-up approach. But you go month by month, how much are we spending? And again, taking all those data elements and building out a pro forma revenue model based upon that data. And then eventually, in this case, they're looking at return on ad spend and other variables that are important to this business. So that's just a quick example.
William, you're a numbers guy who can build these models with his eyes closed. Our audience is a bunch of tech guys. Can you explain to them what the most challenging aspects of building a model, especially model for investors? What are the most challenging aspects?
Sure. So the hard part is going to be the stuff that's the soft things, meaning how do you forecast, right? So that's this bottom up and top down approach, and there's an art to that. It's not just science. Yes, there's a lot of data, but lots of times we don't have data. And so forecasting with unknown quantities, unknown information, you got to use your best guess. And therein lies the art to the process. And so what we need to do is say, hey, well, this is the data that we know. We have other competitors that are doing this. There's market research that says this. Here's management's experience. And we merge all that together in a way to weave a story that's not just plausible for investors, but defensible. And so making that defensible story for investors is sometimes challenging. And so that's really the part that I like to focus in on first and foremost.
Great, thanks. I hope everyone found that helpful. All right, John, let's pass it back to John for the cap table management section.
Sure. And I'll actually add one thing to that, to William's comment. So one of my evening hobbies is I'm actually a small angel investor as well. So I get to see some companies present from both the perspective of Eisner Amper as well as an angel. And I'll tell you, and this is maybe the accountant in me as opposed to the scientist in me. If you can't clearly explain in numeric format and in a budgeting manner what it's going to take for you to be successful, then I'm not convinced you know how to run your business. So you need to know what it's going to take to build that product, to get it approved, to think about the launch, think about what a channel partner is going to help you with. If you can't articulate those things very clearly, then from an investor perspective, that's really impossible to kind of think about what your investment even needs. So I think that's super critical. Anyway, moving on to cap table. The next slide. Next slide, please, Andy. So the cap table is especially as you start to grow your business, this becomes a very important tool for you to keep track of. You're starting off with just a listing of who owns what part of the company. So who owns common shares, preferred shares, what they paid for it, why they got those shares. It'll help you to calculate, like when you're into your next financing round, what dilution is going to look like. So you can do some modeling based on this to say, okay, if I raise money at a pre-money valuation of X and I receive Y dollars, then how much am I going to own before? How much am I going to own after? What does that mean to myself and my other investors? It really helps you to inform those pricing decisions. So you can say, does giving away 30% of the company for $3 million. Does that make sense? What are my other investors going to think about that? It also will help you to think about things like ultimately taxation and use of proceeds down the road as the company may get ready for an exit somewhere down the road. Could you go to the next slide, please? Okay. So here's an example just to sort of visualize this a little bit, and hopefully all of you have seen these before. So you have a couple founders there, Joe and Derek. They got to do something with all their spare time now. So they've started off with this business, and then you can see that there's been some subsequent rounds that have come into play. So you can see sort of in the middle of the page, there was $520 million raise and a $1.05 million and things like that. And you can calculate each portion along the way, how much of the company does everybody own. This becomes really important because you're trying to figure out, your investors want to know like what's their holdings worth, because they have to report to their limited partners and the people who invested in their funds. If you're the founders, this is a significant asset. In many cases, it's your largest asset. It's an illiquid asset. So what do you do with it? Can you use that to help you, eventually, get a mortgage for your co-op or whatever the case may be? So it becomes super important to think about this. And also, one of the things that a cap table will also do is kind of help you drive on your stock options as well. So I am a big believer in having a stock option pool for your key employees. I think it's motivation that everyone's kind of rowing in the same direction. The perspective of thinking about how much you want to reserve for your key employees, your key hires, you typically see like 8 to 10 to 12% of the cap table, which is the total ownership reserved for employees. That could be a combination of maybe you need to hire very high-powered executives as well as build out your rank and file team, maybe some channel partners and the like. So you then need to manage that percentage. So if you're going to give away, say 10% in terms of your stock option pool, then you can dig into how much do you want to give out to each person. So the cap table becomes a really important tool to help you manage a lot of your growth activities.
Hey, John, I'll just add as well, when it gets this complicated with different rounds, you might use a transfer agent to, cement or document all this. So there's no arguing anytime later down the road. One quick question, John. What if they're thinking about raising debt instead of equity? How does that impact the cap table?
So when you think about the cap table, one of the things that it does, and we referenced earlier, like the waterfall. So the waterfall is what happens when you're going to sell the company, and then who's going to get what. So you can see Joe there owns 34.5%. What this will tell you is, and there'll be other layers to this, is it'll tell you who gets money off the table first, right? So the debt gets repaid first. Your seed investors, your Series A investors probably have a higher preference than you do. So there may be terms built into those agreements like liquidation preferences, accumulating dividends, things like that, where they're going to get money. They're going to get money first before the other common shareholders and the common stock option holders. So this tool helps put this together in such a way. A lot of people use Carta or some other tools like Carta to help manage this. Once you start to get a cap table that has more than just a couple rounds on this, and you start putting your stock option plan in place, and it becomes a little bit too unwieldy for stock options. Totally makes sense to get one of those tools. They're good professional tools out there. They track this stuff, including the book accounting, the tax accounting, these waterfall computations, et cetera. And this also helps it make it easier for a potential debt holder to understand who's put money in, at what valuations, and just, again, provides a good level of comfort and convenience for everybody.
Yep, great, very helpful. So I want to save a little time. We have a couple of questions in the QA hopper. John, you want to just give a quick corporate document overview?
Yeah, yep, next slide, please, Andy. So, next slide. So these are the types of corporate documents that you need to maintain. I think you should have some sort of a Dropbox type of tool, a virtual data room. There's a number of different products that you can use, but all of these things should be stored, labeled, readily available, and you could share them with potential partners, investors, lenders, et cetera. I can tell you from an auditing perspective that ultimately there are lots of people who can, there are lots of tools where you can maintain all these things. From the auditing side of things, most of the issues that arise in accounting and tax matters arise from the corporate documents, not from the numbers. So your books are going to be kept, your cash accounts will be maintained, you'll do your bank recs as Eric referenced. But going through and understanding why did people get shares, what commitments have you rendered, what rights and privileges do these investors or these shareholders have? That's what drives accounting. That's what drives complexity on the cap table. That's what drives tax issues. So the biggest challenge we have and the process we go through is we triage before we start audits and reviews, before we start the auditing of the numbers. We triage the company by going through the corporate documents because that's where all the issues are. So again, keep good control of these things, and when the time is right, ask your advisors to help you understand what these special rights and privileges mean. Yep.
Great. All right, so we had a couple of questions come through the chat here. So panelists, question one: we've been asked by a potential enterprise client to obtain SOC 2 certification. This looks painful. Is it? Should we bite the bullet or push back?
So I'm not sure my experience as having gone through it, but John, you're on the other side of that equation, so I'll let you start.
Okay. So this becomes a little bit of a sales tool. Obviously, some customers like fintech companies, they require this before you can become a fully qualified vendor. My experience has been from the auditing side of this. So a SOC report is basically an audit of internal controls of your front-end processing system. So if you're doing payments processing, that your customer who you're processing those payments for can be comfortable that your internal controls work. My experience is that most technology companies build good internal controls. They build those into their processes. Their systems work. They have good backups and redundancies and all those things that you should have. From the auditing perspective, their documentation stinks or doesn't even exist. So it becomes sort of, kind of getting to Eric's point early on about documenting policies and procedures. You can't really do a SOC report until you document your policies and procedures and you have something to audit against. So again, we do a triage process, at kind of an assessment to help companies figure out what they need to do to get compliant.
Great. And we have time for one more question. So if you're pre-revenue, what type of financial assumptions help sell the story? What type of financial assumptions are not important to investors when you're in pre-revenue? Specifically, if you're planning on ads generating the bulk of the revenue. Well, before we ask the panelists, I'll quickly throw in, pre-revenue, it's all about the cash burn, right? How much are you burning? Are you burning it consistently? Are you all over the place? And how much do you have left? Are you going to run out before the raise is over? So cash burn is definitely part of that. William or John, you want to dive in?
Yeah, so I think it's, in my perspective, even if you're pre-revenue or generating revenue, then you're going out for a fundraise, you're still going to want to look through the same financial assumptions as in either event, right? So I don't think necessarily pre-revenue changes how you look at your assumptions. And it's those types of things, actually, in this case, in this question, it's a lot of those things about click-through rates, CPM, conversion rates, etc. So when you're looking at ad revenue, how much are we assuming that's going to flow through to the bottom in terms of, so you can get to a cost of acquisition. So what's my customer acquisition cost, lifetime value of a customer, and therefore how much am I going to need to spend on those ads in order to generate out the other side. So average order value, all those typical metrics for a SaaS subscription e-com business will all come into play. And happy to chat that through with you offline if you want.
Great. So we are just about out of time. I wanted to thank our panelists for participating, and as always, thank New York Tech for being our partner. And Andy, thanks so much for everything you guys do. And to our audience, thank you for listening. And as always, please stay safe.
And we'll distribute the deck out, right, Andy? Is that correct?
That's correct. Thank you everybody for participating in today's panel and for listening to the panel. If you have specific questions for the panelists themselves or for me at New York Tech Alliance, you can always reach us directly. I'm going to click through and find the contact for the CEO's right hand. It's up on the screen. So you can definitely reach out to William or Eric directly. John, we are connected to as well, and happy to connect you directly to him. And then my email address is andy@nytech.org. You can find it all over our website, so feel free to connect with us directly there as well. Again, thank you everybody for today's participation. We did gather all of the questions, so I'll make sure that the panelists have them, and hopefully we can get them out to you in a recap email. Thank you so much, and enjoy the rest of your afternoon.
Thank you.
Great. Thanks, Andy.
Thank you.